Hi, this is Mike Larson from Money and Markets TV. Remember when things like earnings and the state of the economy really mattered? When a spate of disappointing quarterly reports and profit warnings, like we've seen over the past 2 weeks, would have resulted in a major stock sell-off? That was only a couple years ago, but boy have things changed. Now the markets are being held hostage by the machinations of bureaucrats and central bankers. And of course, the latest proof came in the form of the Federal Reserve's two-day policy meeting, which wrapped up yesterday. As expected, Ben Bernanke and company announced a third round of quantitative easing, under which they will print $40 billion in new money a month to buy mortgage-backed securities. The Fed will also continue its Operation Twist program, selling short-term treasuries and buying longer-term ones at a pace of about $45 billion per month. Finally, Bernanke said that interest rates will stay at exceptionally low levels through at least mid-2015, an extension from the current 2014 timeframe. But what's different about QE3 is the condition of the markets going into it. When QE1, QE2, and Operation Twist were launched, stocks and commodities were plunging, and fear was running rampant. Obviously, that's not the case this time. When the Fed launched QE1 in November of 2008, investors were expecting inflation of just 2% over the coming 5 years. And in August of 2010, when Bernanke strongly hinted at QE2, inflation expectations were at 2.2% and falling. But now they're holding steady at around 2.6%, and inflation at the wholesale and consumer levels just recorded their biggest surges in 3 years last month. Then there's the stock market. The Dow Jones Industrial Average was trading at just 8,300 when QE1 was rolled out, and around 10,000 at the time of QE2. Before the announcement of QE3, it was trading at nearly 13,400, a level we haven't seen since 2007. Meanwhile, commodity prices are elevated across the board, from crude oil and gasoline to corn and soybeans. And fear in the marketplace, as measured by the CBOE Volatility Index, or VIX, is at its lowest level in 5 years. All this evidence leads me to the inescapable conclusion that QE3 is largely already priced into the markets. And if that's the case, what comes next will probably be the mother of all sell the news reactions. So my prescription remains the same. Maintain some broad hedges against risk, and look for opportunity in a few select names that can prosper in almost any market environment. That's especially important now with the massive fiscal cliff looming. I'm Mike Larson for Money and Markets TV. Thanks for watching.